Let's talk about investing. FamiLei here, and I'm sure you know that investing is so important for your financial freedom, but you might not know where to start. There's so much information out there, a lot of jargon to understand, and a lot of different investment philosophies that make it difficult to really figure out the answers you are looking for. Today, I'm going to be covering a lot of different topics, but I'm only going to be covering the vital information that I believe you can find timestamps for every single topic I'll be covering in this video, from what is investing to what investment approach should you have, as well as where you should be investing your money. On top of this, I actually have made videos the past year going into a lot of these topics in depth. So if you want more information about each individual topic, I'll be sure to link it in the card and description below. With all that being said, let's just go ahead and dive in. Investing is the act of purchasing something with the hopes that it increases in value over time. With stock market investing, you are purchasing a stock with the hopes that it makes you money either through capital gains when the stock price increases, or dividends, which are earnings that companies will pay out to its shareholders or stockholders. You should be investing because you want your money to work for you and help you reach financial independence or a large lump sum of money. What's so powerful about investing is that your money you put into the stock market will make more money, and that larger amount of money continually makes more, and it kind of stacks on top of itself. This is called the compound effect, where a little penny compounded over many years can actually lead to a lot of money. There are all sorts of things that you could be investing in nowadays, from bonds, real estate, cryptocurrency, Pokemon cards. With all of these different things that you could be investing in, my only rule for you is to only invest in things you understand. The three most popular things I'd say people invest in are stocks, bonds, and real estate. Real estate is not exactly a passive way to invest unless you have a property manager who does everything for you. It can lead to a lot of headaches repairing houses and all your rental units. But with stocks and bonds, it's a very passive way to invest because all you have to do is contribute money into your account, buy the stock or bond, and then just let it sit. And actually, that's the best way to invest, to just set it and forget it. Stocks represent partial ownership of a company. So if you own a stock or a share of a company, then you are a partial owner of that company. Bonds, on the other hand, are like an IOU. These can be given by governments or companies, and basically these entities are lending out money with a set amount to be paid back by a certain date. Usually the amount they lend plus interest. The two biggest differences that you should care about are the rate of return and volatility. Stocks are very volatile. They go up and down. Swings really depends on how people feel about the market. It can go up 40% one year and drop 100% and go bankrupt. Bonds, on the other hand, grow very continuously, and they are a lot less volatile than stocks. Stocks usually offer investors a higher rate of return, while bonds offer investors a more stable ride. Just to give you some numbers, the average rate of return for the US stock market is about 10% every single year. On the other hand, the average rate of return for the US bond market is about 5% every year. As a general rule of thumb, if you're relatively young or have decades until you plan on withdrawing from your investment accounts, then you should be going 100% in stocks if you are comfortable with the ups and downs that come with the stock market. Over the long run, going 100% stocks will give you a higher rate of return, aka more money. If you are, say, 10 years from retirement, then you might want to consider adding in bonds so that by the time you get to retirement, you'll be able to withdraw from those bonds in the case that the stock market crash. One important thing to know is that when the stock market crashes, your losses are only on paper. They don't become real unless you sell your stocks. In the event that you're withdrawing money from your investments and a stock market crash occurs, you'll be able to withdraw money from your bonds so that you don't have to make your stock losses real. If you want to deep dive into the exact percentage of stocks and the percentage of bonds you should have in your portfolio, you can check out my video here and in the description below. Let's talk about investing in individual stocks. Individual stocks are shares of a certain company, say a stock or share of Amazon, Facebook, Google, etc. And you can invest in individual stocks, but the risk of these are very high. If you have all of your money tied into one company and that company tanks, whether it be from not reaching expected revenues or having just bad publicity, then all of your money tanks with that company. On the flip side, if that company does really well, then you will make a boatload of money. There's a lot of risk, but a lot of reward for investing in individual stocks. Now, finding good companies to invest in is not something that I'll be covering in this video. The process is actually quite complex, and in the end, you might just be better off investing with the entire stock market rather than picking and choosing companies that may or may not succeed. What I can suggest is that the percentage of individual stocks in your portfolio should reflect your risk tolerance. As a general rule of thumb, if you have that itch to invest in individual stocks, you can start out with 5% of your portfolio in individual companies you like, whether that be companies that live up to your ethical standards, companies that are in a specific niche like solar or alternative energy that you like, or just companies you believe will grow in the next couple of years. If you want to take on more risk, then you can bump up that percentage to say 10%, 20%, 30%, or even more. Keep in mind that I like to think of this as just play money, and if I lost half of it, then I wouldn't be too mad. In the end, picking individual stocks may simply just be speculation and what you believe in. So with your individual stocks, keep it at a percentage that you're comfortable with losing and just have fun with it. There's a better way to invest for individuals who know investing is important, but you don't want to spend all your time researching and picking individual stocks, plus all the anxiety that comes with watching that stock price go up and down. It's through diversification. Diversification in terms of stock market investing can be easily done by investing in an index fund. An index fund is simply just a fund or a basket of stocks. They may contain hundreds, if not thousands, of individual companies within the fund. A good example of this, and a popular one, is the S&P 500 index. The S&P 500 index contains the top largest 500 US companies. So if you buy one stock in a S&P 500 index fund, you are actually buying all 500 companies held within that index fund. This is honestly such a powerful way to invest, and if you put 100% of your money into the S&P 500, in a couple of decades you will come out with a large lump sum of money. Even Warren Buffett, who's world-renowned as the best investor, recommended to his wife that when he passes away to just put 90% of the money into an S&P 500 and the remaining 10% into bonds. More than 95% of financial professionals can't even beat the S&P 500. Not only does investing in an index fund usually give you higher returns, it also shields you from the fluctuations that come with individual stocks. If one of the companies in the 500 companies go bankrupt, people invested in that one company lose all their money, but you still have 499 other companies that are lifting your portfolio up. There are 4 main ways that you can diversify when investing in stocks. You can pick the individual stocks yourself and have 30 to 100 or so companies that you really like and do all the research for. You could also invest in a mutual fund, which are actively managed by financial professionals who take a percentage of your portfolio in exchange for managing that fund you invest in. A better way, I'd say, is a low-cost index fund. These are technically also mutual funds, but they are, unlike the actively managed mutual funds, they are passively managed. They simply pick an index and track that index. An S&P 500 index fund will track the S&P 500, and the total US stock market index fund will track a total US stock market index. The last way, which I believe is more accessible to a lot of beginners, is investing in an ETF or an exchange traded fund. These are very similar to a low-cost index fund, but the biggest difference is that with an index fund, there might be a minimum amount of money you have to invest in, like $3,000, to actually start investing with that fund. An ETF is sold just like a stock, so if you have enough money to buy one stock of it, or if you're investing with an app that allows you to invest in partial shares, then you can be investing in an ETF for as little as 1 penny. I go over the pros and cons of ETFs, mutual funds, and index funds in a video here and in the description below. How do you pick good index funds to invest in? When it comes to investing, there's a lot of things you can't control, like the stock market itself and how much money you're making. If there's one thing you can control, it's the fees you pay with the funds you own. With an actively managed mutual fund, you are typically paying 1% every single year. So if you invest $100, you pay $1 of that. If you invest $100,000, you are paying $1,000 every single year, just gone. With low-cost index funds and ETFs, you are paying as low as 0%, which is a great starting point to have. I mean, you can't get much better. So finding good index funds is a very tricky thing to do because there are hundreds, if not thousands, of options for you. There's index funds that track a variety of different indexes, such as the S&P 500, total US stock market, total international stock market, emerging markets, sector-specific ones like healthcare, finance, technology, and very niche ones such as the airline index, as well as the alternative energy index. With so many different indexes out there, it can be difficult to pick which ones you actually want. But if you want to keep things simple and only invest in one thing, then I would say go with a popular S&P 500 or a total US stock market index. And with these two indexes, there are a lot of different companies that have their own variations on it. I'd say the most popular ones are Vanguard, Fidelity, and Charles Schwab. I've made videos on the total US stock market and why this may be the only stock you ever have to invest in, and it's definitely worth checking out. I've also done a video comparing the total US stock market with the S&P 500 and the differences and pros and cons between the two. So be sure to check that out as well. I'd argue that the best way to invest is to pick an investing approach and stick with it. So say you want to go 100% into the total US stock market, put all of your money into that and just stick with it. Keep adding money as you make and save more money into that fund. There's really no need to make things complicated. You can just set your money into that fund and forget about it. Future you will thank you. Honestly, the biggest thing that will derail your investments is you. People get nervous. They sell when the stock market crashes and they feel like it's gonna go more, but it doesn't. And they also try and time the market saying that, oh, the stock market's a bit too high, I'm gonna wait a little bit, and then 10 years go by and the stock market never crashed. Fidelity did a study on investors, and the best investors over a long period of time were those who simply forgot about their money or those who had died. And so they never touched their money. I would say to just start with 100% into an index fund you like, such as the total US stock market, and then start to deviate from that and invest in things that you are interested in, such as innovative technologies, where you can buy an ETF that focuses on things such as autonomous vehicles, Internet of Things, and cryptocurrency. Now you know investing is important, and you know the different options you have, from investing in individual stocks to a low-cost diversified index fund. But where exactly should you be investing all of your hard-earned money? There are 3 accounts that you should know. There is a Roth IRA, which You contribute after-tax dollars, but when you pull that money out in retirement, all of that is pulled out tax-free. There's also a 401k, which is an employer-sponsored retirement account where you can put money in before taxes or after taxes, and then when you pull it out, you will be paying taxes the opposite of what you chose when you initially contributed. There's also a taxable brokerage account, which has no tax benefits, is not a retirement account. These are your typical investment accounts that you can open really easily with Robinhood, M1 Finance, Vanguard, or anything of the sort. Here's the order in which you should be investing into each account. First, you should get your employer match for your 401k. A lot of companies these days will give you an employer match. An example of this is that a company might match you 5% every single year. So if you're making $100,000 every single year, your company will put in $5,000 as long as you put in $5,000 into your 401k. This is essentially doubling your money. The money's already there. All you got to do is put your own money in and they will match you. There are many different kinds of 401ks. If you're in corporate, then you have a 401k. If you're a healthcare worker or in education, you'll have a 403b. And if you are in the government, you'll have a TSP. But for the sake of the video, I'm going to just call all of them a 401k. You'll have two different types of 401ks, a Roth 401k and a traditional 401k. A Roth 401k is similar to a Roth IRA in that you put in after-tax dollars into those accounts, and eventually when you pull it out, you'll be pulling it out tax-free. A traditional 401k is when you put in dollars that haven't been taxed initially, and then eventually when you retire and pull money out, you get taxed then. I have a video explaining the differences between the two and exactly how to purchase stocks in a 401k that I'll link in the description below. But the general rule of thumb is if you plan on withdrawing more money in retirement, then you should be investing in a Roth 401k. But if you're making a lot of money now and you don't have to pull out a ton of money when you retire, then you should invest in a traditional 401k. So after you get the maximum employer match for your 401k, you should invest the maximum amount for a Roth IRA. As of now, the maximum contribution limit is $6,000 per year. And after you hit that 6K limit for a Roth IRA, you should go back to your 401k and max that out. As of now, the maximum for a 401k is $19,500 per year. Then after those two retirement accounts are maxed out, you should be investing into a taxable brokerage account. These don't have any tax benefits, which is why we invest in those last. If you decide to open up a Roth IRA with Vanguard, I've made a video going step by step how to purchase stocks and index funds, so you can follow along in that video. And if you want an example of how to purchase stocks in a 401k, I also have an example of that using a 401k through Fidelity. A lot of people wonder, when should I buy? When should I just put my money into the stock market? Is the stock market too high, too low? What's the deal? And really, no one really knows whether the stock market will rise or fall for any given year. Statistically, the best thing to do is invest all of your money at once. This is called lump sum investing. All of your money that you have, you just dump into the stock market, and chances are the stock market will rise and you will profit from that. If you are a little bit nervous and really think that the stock market might crash, then you can use something that's called dollar cost averaging. Taking your money and spreading it across different weeks, months, or however intervals that you want to invest with. So say you have $6,000 that you want to invest. You can invest $2,000 at the beginning of every single month. This might ease your worries about investing when the market's too high, too low, or not, because you are investing the average of those 3 months. A huge beginner mistake, and frankly a lot of investors make, is market timing. This is the act of trying to sell stocks high and buying stocks low. It's very hard to do this, and over the course of a decade, this is nearly impossible to do. The best thing you can do is to buy and hold your investments. So pick an index fund, buy that index fund, and hold it for decades until you want to retire. There are a couple of things that you want to set up so that you can really make investing passive. There is automatic contributions. This could simply be setting up automatic contributions from your bank to your Roth IRA in the form of $500 every single month. That will max out the $6,000 contribution limit. On top of this, you want to set up DRIP or dividend reinvestment plan. I said a bit earlier in this video that dividends are earnings that companies make that they pass on to their shareholders. And if you don't set up DRIP, then your money just sits in your account and it's not actually invested. You want to make sure to set up dividend reinvestments so that the dividends you have get automatically put back into the same funds that you are holding. To close out this video, the best thing you can do with your stock market investing journey is to set up your investment strategy and get out of the way. Be sure to check out my other videos and resources that I'll link below for more information on investing. Thanks for watching and happy investing. Peace.